Hello everyone, welcome to this channel. My name is Ruben and today we are going to talk about Palantir Technologies. We'll start with a capital market summary, do a deep dive in this company. You can see that here. CEO Alex Karp will explain what is Palantir doing. I have three very interesting demos for you. Foundry, Gotham, Apollo, several takeaways and some other stuff. And after that, we will see what is the opinion from ARK investors on this company, insider trading, stock-based compensation, and lots more. So stay tuned and let's go. Let's start with the capital market summary. Palantir did an IPO last year in the end of September for around $10, and right now at the day of the recording we are trading at $24. Regarding the market capitalization, it's 45 billion and the price to earnings ratio is not visible because Palantir is still making a loss.
How would you, in under a minute, describe what Palantir is, what Palantir does?
Well, first of all, I want to thank Richard for the very kind introduction, which means a lot to me and all of my fellow Palantirians. Palantir supplies world-class software to some of the most important institutions in the world, especially those in the intel and defense world, America and its allies, and to commercial entities all over the world. The software is the underlying motor of their work. So it powers special forces, it powers a lot of the operations that are done, it powers the way in which intelligence and clandestine services all over the world do their work and in correspondence with civil liberties. And on the commercial side, there's 1,000 applications for our data integration motor and the full stack of software we provide. The shortest answer is, in a world where software is largely a complete and unmitigated disappointment, if not disaster, and comes in the category of useless or totally non-working, we supply software to the institutions that I think most of the people in this room believe support us, including the institutions that you run. That is not only useful, but in the clandestine context, often exceedingly useful, both in terms of finding our enemies and protecting our civil liberties.
Palantir basically offers three types of products, also known as Foundry, Gotham, and Apollo. And in this demo, we will start with Foundry.
What is Foundry? Foundry is a first-class data integration and management platform, a comprehensive suite of analytical tools, and an operational platform of applications for business users. But at its core, we believe Foundry is the central decision support infrastructure for any organization. We've built a software framework that translates data and models into knowledge that human operators can use to make better decisions. The Foundry ontology and simulation engine we are demoing today represent this connective tissue between assets in the digital world and actual decisions in the real world. Let's look at what this means for a large supply chain. As we built Foundry, we quickly learned that the amount of data in any organization is constantly increasing, creating a massive amount of entropy. For example, in a single supply chain project like the one you see in front of you, you might need to ingest thousands of tables from a single ERP system alone. And in data from other systems like operations, customer demand, and finance, and you quickly realize that it's extremely difficult to understand or discover anything from the data, even with all of it in one place. This is why companies spend years on data projects without any clear business outcomes. We determined pretty quickly that we needed to take a different approach. Palantir Foundry's ontology and simulation engine technology is our unique solution to this challenge. It preserves granular data governance and security while mapping all data into a shared, easily understood framework specific to the organization. This ontology, the representation or the digital twin of an organization, provides a common interface for all downstream workflows, from search and analysis to operational applications like supply chain optimization. It is also a two-way interface between an organization's digital assets and its real-world operations, allowing teams to feed their unique insights back into a common understanding of the business. Let's take a manufacturing plant as a first example. To create a 360-degree view of the plant, we are joining massive amounts of data, like sensor data from plant operations, or logistics data from distribution centers, or financial data from ERP systems to create the plant object. As we continue to integrate data to support more and more use cases, our ontology continues to grow. We also link the plant to key entities like distribution centers, customers, and raw materials, which are backed by even more data sources. The result of this data integration and mapping work is immediate transparency into the business objects, that plant, for business users across the organization. As a supply chain manager, a logistics officer, or a plant operations manager, I can see all the data that has been integrated to develop that plant object. And for any single plant, I can quickly see the most relevant KPIs to understand customers and distribution centers by city, as well as any demand alerts and the demand in production over time. Importantly, this ontology is dynamic and it changes over time, expanding as digital transformation starts to include more parts of an organization, and changing as the organizations themselves evolve. Traditional ERP systems and inflexible data models cannot handle these inevitable changes. This ontology goes beyond integrated 360-degree views. It's the foundation for all decision-making through search, analysis, reporting, and applications. This approach is transformative for several reasons. Instead of reinventing data foundations for every new project, you now have a compounding framework for new data to automatically flow into business applications. This radically decreases the time to build new workflows and provides a built-in shared language for collaboration across functions. What's most exciting is that this framework is bi-directional. All user insights and decisions are recorded in the ontology, where they become immediately available as data for others to build on. This enables unparalleled cross-functional collaboration. For example, imagine a supply chain analyst discovers excess inventory of a particular raw material that will expire in a few months. They can flag this as an opportunity, notify a customer account manager, and from there identify potential sales opportunities for those finished goods.
The second explanation and demo for Palantir encompasses Gotham.
The new Gotham launch helps commanders quickly understand not only the choices available to them, but the second and third order costs of those choices. It's a game changer and applies to every business in the world. In many ways, this is the most important problem of our time and critical to our nation's prosperity and our way of life. At Palantir, we've got our best engineers working to take every sensor, data feed, and database out there and integrating them together to give leaders across echelons a holistic view of their world and allowing them to optimize their split-second decision-making. This is a big deal. Shortly, you'll hear from Gotham's lead product manager, designer, and implementer who will share their experience born of supporting the warfighter, forward deployed with the warfighter in conflicts all over the world. I know because I was there with them. Through a variety of challenges and learnings along the way, we've had a very real breakthrough. And we are combining the best capabilities of our platforms in a way that has an amazing synergy and a real world impact. So with that, see it for yourself.
for the third demo, we will focus on Apollo.
Apollo is the silent third platform that sits behind both Foundry and Gotham. It is what allows us to meet our customers where they are, to power their missions and solve their most important problems, no matter where in the world these are.
Apollo manages the end-to-end set of software platform considerations, from our developers' keyboards all the way to our customers at the front line. At the core of Apollo is an end-to-end, highly extensible framework for continuous delivery in all environments. It provides an autonomous control plane for the continuous delivery of standard new product features, security updates, and platform configurations.
But Apollo is also designed to meet the complex realities of our customers. It understands the granular state of Foundry and Gotham worldwide, and it's responsible for ensuring that the whole fleet is healthy and up to date. And it does so while working within the confines of each customer's unique requirements. It takes a sophisticated approach to rolling out new releases, including blue-green upgrades with composite success criteria, and a fully autonomous approach to rollbacks in cases where health criteria aren't met. The platform's observability framework works hand in hand with continuous delivery, leveraging both synchronous and asynchronous telemetry to monitor the complete lifecycle of every single piece of software.
As you'll hear about shortly, Apollo's reach extends far beyond traditional SaaS architecture. From the autonomous management of edge devices, including those within heterogeneous and shifting network topologies, to capabilities further up the stack, including the complete lifecycle management of machine learning models.
To date, Apollo has been key to increasing velocity of both new and our existing SaaS business. This year, we saw more customer onboardings than ever before, with many fueled by real urgency around COVID-19 and other critical problems facing both public and private institutions alike. Apollo enables us to onboard these new customers to our SaaS in a matter of hours.
But not only can we service new customers more easily, but with Apollo, our developers can roll out features to the entire existing fleet automatically. Apollo is the beating heart of our platforms, working around the clock to continuously deliver software to our customers.
It's not only automated, but intelligent, enabling our developers to not only push changes, but to push them with confidence, shipping new features faster without compromising on stability. Through the use of release channels, soak times, blue-green deploys, and maintenance windows, we ensure that our highly available system stays highly available.
While we've been in the cloud since 2013, it's only in the past couple of years that we've seen massive adoption of our SaaS platform. Where large conservative institutions once viewed SaaS and the cloud more generally with a healthy amount of skepticism, we've since seen a shift in viewpoint. By successfully demonstrating its value to our customers, these organizations have come to embrace our SaaS platform. In 2020, nearly all of our customers opted for our cloud-based SaaS. This includes industries that are very highly regulated, from financial institutions to utility companies to governments across the globe. SaaS also powers our COVID-19 response work, supporting over 100 private companies and 10 governments, including the US and the UK. Our SaaS is also used heavily by the military, both in the US and abroad.
With Apollo, our SaaS is able to meet our customers' most stringent requirements. Our natively multi-homed architecture provides fault-tolerant, resilient platforms that are replicated across distinct physical sites. And our global footprint ensures that we meet our customers' evolving data residency requirements. We offer a wide array of connectivity options for customers with private connections, custom access points, and other non-standard networks. And it's backed by our auto-scaling infrastructure that adapts to spiky workloads, handling large data volumes seamlessly, eliminating the tedious and often error-prone burden of capacity planning. Taken together, all these options have allowed us to bring some of our most conservative customers to use SaaS in the cloud for the very first time.
Apollo's flexibility enables our SaaS platform to support the requirements of the world's most risk-averse and most mission-critical systems today. You can see some examples here listed of these systems. Suffice it to say, they need the latest technology, and they also need it without risk of downtime. Apollo is able to deliver. Our SaaS is authorized to be used for mission-critical national security systems by the US Department of Defense. This authorization is the most stringent for unclassified data, and you can count the number of other SaaS systems who have this accreditation on one hand. We are committed to continuing to support the world's most important institutions by ensuring that SaaS-like efficiency, coupled with reliable stability and top-notch security, are our top priorities.
We built Apollo to be infrastructure agnostic, liberating our customers from cloud vendor lock-in. Apollo powers critical workloads and spans multiple cloud providers today. And with Apollo, we are taking our SaaS beyond the usual hyperscale providers like AWS and Azure, and we will thrive in a world of future cloud vendor balkanization. For example, we're day one members of the Gaia X initiative, the recently announced project to build a common data infrastructure for Europe. And we also know that the landscape changes rapidly, so we're taking this a step further. The large organizations we work with aren't homogeneous internally. They know the future is multi-cloud. So we are actively investing in the ability of our customers to dynamically shift workloads between infrastructure providers on demand. And we're working towards a complete BYO ecosystem that will empower our customers to bring their own storage and compute wherever it may live, natively to our platforms.
Apollo enables not just multi-cloud, but multi-classification SaaS as well. Running software on classified networks today has its own set of unique challenges. Lack of outside connectivity, additional security and compliance constraints, and the need to transfer data between networks physically using DVDs, to name a few.
Apollo's flexibility means that it works across all classification levels. Apollo is running today in unclassified, secret, and top secret environments, powering the same SaaS platforms that you see in the public cloud. Apollo enables us to improve the speed and delivery of software binaries, bringing the latest features to classified environments nearly as fast as they make it to the public cloud. It also powers crucial cross-domain workflows, automatically synchronizing critical data assets across these very same networks.
We are defining what it means to be a SaaS in the classified space. We're moving from a world of slow and minimal upgrades with static software that quickly gets out of date to a world where the benefits of SaaS can be realized in the classified world as well. We will solidify this position by becoming the first SaaS authorized for the US Department of Defense Impact Level 6, enabling us to scale even more quickly across secret networks.
Apollo also takes our platforms to places where no SaaS has gone before, to challenging physical conditions, war zones, remote deserts, across oceans, to places with delayed, disconnected, intermittent, or low bandwidth environments, places where network cables do not exist, to mobile and ruggedized places, Humvees, subs, downrange data centers. These are all places where customers historically have only had access to legacy, static, custom-built systems. But we've changed the game by bringing the same powerful software available in industry to these challenging environments, providing them with our platforms that are always cutting edge and always up to date.
There are 5 takeaways for Palantir that I really want to share with you. First, they are offering a free trial of Foundry to companies that need help with reopening after COVID-19. Given that they have found COVID-19 to be a dynamic long-term growth catalyst simply by how it made more government agencies aware of Gotham's existence and capabilities, there is reason to share management's optimism that this initiative will have a similar impact on jumpstarting the growth of Foundry. Second, Palantir is heavily investing into the sales team. In the first quarter alone, they added nearly 50 sales personnel, and they expect to add well over 100 by the end of this year. Palantir is also making investments surrounding these sales personnel in order to boost their effectiveness and the quality of the opportunities that they receive. Well, some examples of this include the recent partnership with IBM and a soon-to-be detailed initiative that will offer free education in the Foundry platform to strategically targeted individuals in order to boost name identification and platform familiar that will translate to a greater platform adaptation and distribution over the longer term. Third, Palantir is investing in some of its clients. In exchange for using their Foundry platform right at the beginning of their company's growth, Palantir is buying equity stakes in these companies as a way of increasing distribution of its products and also diversifying its revenue streams. 4. Palantir is now accepting Bitcoin from customers as a way of making business transactions more convenient, and they may actually hold it on its balance sheet in the near future. Furthermore, in a recent interview from the Chief Operating Officer, also known as the COO, Shyam Sankar, he stated that Palantir is engaging in active efforts to explore how they might play a role with Bitcoin and ensuring that it is not weaponized in the future. And finally, the 5th one, Palantir is beginning to see accelerated growth among small and medium-sized businesses. causing their qualified pipeline to increase by 2.5 times in the United States and the United Kingdom. In the following clip, the CEO Alex Karp will talk more about why the United States will continue to produce disruptive software companies.
Why do I think America will continue to produce world-class disruptive software companies? It's because there's a culture to do this. The culture is disruptive and the output is totally nonlinear. So one country can spend $100 billion and a small group of startups in Chicago can get financing worth 100 million, and they just massively outperform the country that spent the $100 billion. And so to your question, I believe the West, and America in particular, needs the best software-enhanced systems or software systems precisely so that we don't have conflicts. Because if in fact our adversaries have the best software systems, software-empowered systems, or in the end, pure software, which you could call advanced AI, AI is often thrown around as a jargon term, but in this context, military technology powered by somewhat or completely autonomous systems, or human-powered systems that also have autonomous capabilities. Those capabilities are not going to be even. It's not going to be one is here and one is here. It's one is in the at the moon and one is at a skyscraper range. And the country, and this is where I just flat out have a disagreement with most people, I would say in the Valley, but often others, and it's a legitimate disagreement, I guess. I believe if one country has a nuclear bomb and the other country has a set of dull knives, the country with the nuclear bomb is going to define how the world works. And they are going to have very little interest in what, maybe, and many of my academic friends disagree with me. I believe in universal norms. I want universal norms. I believe in like Kantian ethics and the American Constitution. But if our adversary has a nuclear bomb and we have a dull knife, I do not believe that these kind of norms will ipso facto sprout from the hearts of humans, and the world order that we like to live in will actually exist in the way we like to live in it. And I think the mistake in the framing is to either, on the one hand, assume that the delivery of arms is going to be in any way similar, so that's linear, so it's a 10-20% difference, and you can make up with it by spending extra capital, which is just not the case in software. Or they believe the norms of our adversaries will inherently migrate to our norms under some kind of interesting self-referential dialectic that happens automatically, which I largely don't understand as an argument. Now that you can have that argument, I don't understand it and don't subscribe to it. And at Palantir, we believe that to have the kind of norms that we want to live in the world, there has to be parity, at least parity, if not superiority, in the context of delivering software to America and its allies.
Is there a country that's close to being ahead of the US or has a chance of being ahead on this front? China, perhaps, Russia, Korea?
Well, China and Russia are both one of the things I did this crazy PhD in Germany, and one of the most important things I learned was that we were taught to take the argument that we are disagreeing with it, make it into the very best argument humanly possible, switch out everything, and then defeat the argument. And so, I think we should just, because we have so many disagreements with China and Russia on so many fronts, we should not ever underestimate how sophisticated these cultures and countries are at highly technological things, including software, but other things that sometimes involve weapon systems, but just involve other things that just involve in technology. These are highly developed, highly capable, worthy in the sense of they can produce things we can produce or better if we're not careful adversaries. And in both cases, I would be certainly we would be remiss not to put our best foot forward. I would say in this context, one of the things that I believe is in Palantir and in my years of building the company and running it is you really have to focus on your own business. So it's like the most helpful way to beat our rivals is to put our best foot forward, not to run around talking about how great they are. Obviously, we have to be aware of how strong they are. But America is more than capable, especially in the software context of winning. But it is very much the case of putting our best foot forward. And to your point, if we do not put our best foot forward, we won't win.
Palantir continues to onboard new clients. One of them is Lilian, which is a revolutionary eVTOL, also known as electrical vertical takeoff and landing transportation company, that will use Foundry for design, engineering, testing, procurement, production quality, logistics, and in-service operations. On May 28, Palantir was awarded with a $111 million contract to provide a mission command platform for the United States Special Operations Command. A company within a different industry is Sarkos, and they are using Foundry for industrials and manufacturing, and they are fusing Apollo for edge AI into their exoskeletons. In the following clip, Will Summerlin from Argenvest will give 2 reasons on why Palantir is an interesting company.
I wanted to get your kind of take on Palantir. What kind of how do you assess kind of Palantir's, unique product kind of value proposition, their competitive moat, their future? What is kind of, their bigger picture, trajectory, and how do you evaluate that company?
Yeah, it's funny. I think Palantir is one of the, at least initially, was misunderstood. I think most people thought, and some people still think, that Palantir is a services company. I think that's fundamentally untrue. If you look at their financials, they don't have the sort of margins of a services company. But I think what Palantir is they have a really powerful sort of data and AI platform at their core, and then they have really smart people, forward deployed engineers who basically go into a company, integrate their data streams, and then help unlock value from that platform. And I think that Palantir is interesting to me for 2 reasons. I think one is they're selling a solution, and they're selling from the top down. And so they'll go to the CEO of an oil company or the CEO of a bank, and they'll say, "Hey, what are your highest priority issues or problems to solve for the year?" And they will basically sell in a solution which involves primarily that licensing of that data platform, but then all the services that are required to make that a reality. And I think the second reason why it's interesting, if you think about kind of the dynamics that we discussed in the first episode of AI within legacy companies, AI inside of non-founder-led companies, it's really hard, and it's hard for a number of reasons. One reason being it's hard to attract talent. And so if you're a big bank or you're a big oil company or you're a government agency, you're competing with Google and you're competing with Facebook and you're competing with all of these great companies to try to acquire talent, to try to hire away the great data scientists and the great AI engineers. And it's hard for you to compete. A CEO of a bank, because of the incentive structure, because of the organization, because of all the political challenges, they can't just go pay recent PhD graduates from MIT $1 million salaries and give them the freedom to work on whatever they want. And they know that. I've had conversations with executives of some of these big companies, and they understand that. And so they see a company like Palantir as a solution to that problem. They basically say, okay, well, I can't hire away all those PhDs from MIT, and I can't pay them $1 million salary, but I can take sort of an allocation of my budget, take say $5-10 million, and I can pay Palantir to deliver something that is similar, that would otherwise be created by all these PhDs I would hire. And so, I think that's kind of the dynamic that's at play here. I think that executives at old world companies, executives at large companies, officials within government agencies see Palantir as a way to embrace their data assets, as a way to leverage AI, as a way to sort of improve the efficiency and unlock knowledge locked within their system without the constraints that they would have of going out and trying to hire a bunch of smart people from MIT or Stanford or Caltech to do it in-house.
They basically argue that deep learning is software 2.0. On the x-axis you have time, and on the y-axis you have software capability. And the graph is divided in software 1.0 and software 2.0. In the 1970s, commercial software began with the founding of Microsoft, Oracle, and SAP. In the 80s, object-oriented programming made software reusable and increased its scale and capability dramatically. Then we moved to 2000, and in 2000, the internet democratized software, growing the market from millions to billions. In 2012, deep neural networks won the ImageNet challenge, marking the beginning of the deep learning software 2.0 era. And then you have this dotted line, vertical line, 2015. Then we are moving more to software 2.0, and that is code written by data. And during the next decade, ARC believes that the most important software will be created by deep learning, enabling driving cars, accelerating drug discovery, and more. Deep learning is creating the next generation of computing platforms. They divide it into three things. The first one is conversational computers. You can think about Alexa, so powered AI, smart speakers. They answered 100 billion voice commands in 2020, and that's 75% more than in 2019. Then you have this self-driving cars. Waymo's autonomous vehicles have collected more than 20 million real-world driving miles across 25 cities, including San Francisco, Detroit, and Phoenix. And the last thing that they discuss is consumer apps, such as TikTok, which uses deep learning for video recommendations that really has outgrown Snapchat and Pinterest combined. Deep learning requires boundless computational power. On the x-axis we have time, and on the y-axis we have cost to train with 2020 hardware. And ARC has the following to say about this. While advances in hardware and software have been driving down AI training costs by 37% per year, the size of the AI models is growing much faster, 10 times per year. As a result, total AI training costs continue to climb. We believe that state-of-the-art AI training model costs are likely to increase 100-fold, from roughly 1 million today to more than 100 million by 2015. It's like a vertical line here, and the dotted circle shows a range of cost possibilities, with the bottom line representing the outcome if progress slows down. The latest developments have been GPT-3, Mena, Tesla Autopilot, and AlphaFold 2. Deep learning is creating a boom in AI chips. If you look at this graph, we have the total AI chip market starting in 2016 with a compound annual growth rate of 50% till 2020, and from 2021 to 2025 we have a compound annual growth rate of 33%. As AI training costs grow from 1 to 100 million per project, specialized processors such as GPUs or TPUs, they will account for a majority of the incremental growth. And ARC estimates that data center spending on AI processors will scale more than fourfold during the next 5 years. So that's growing from 5 billion a year today to 20 billion in 2025, and this upcoming deployment phase for deep learning will democratize access to AI, benefiting not only large internet companies but also every industry in this economy, because we're going to use more data, you know. Currently, AI is expanding from vision to language. 2020 was the break year for conversational AI. For the first time, AI systems could understand and generate language with human-like accuracy. Conversational AI requires 10 times the computing resources of computer vision and should spur large investments in the coming years. So on the x-axis we have time again, year, and on the y-axis we have computing time, petaflop in days. So pre-2010 we had pre-AI. Industry penetration is most global 2000 companies today. We move 5 years forward to 2015. We have computer vision with select technology companies and startups. Then you had this era from 2018 to 2000. AI giants like Google, Facebook, Amazon, and OpenAI. And as of 2020, we are in the phase of reinforced learning, and that's going to be the focus on research organizations. Seizing the opportunity, deep learning could create more economic value than the internet did. Let's have a look at the graph. They make a distinction between the internet wave and the deep learning wave. The internet wave is from 1997 to 2000, with internet having a value of 13 trillion. Deep learning had a value of 2 trillion in 2020. And if you fast forward to 2037, internet will have a value of approximately 20 trillion, and deep learning has grown exponentially to a value of 30 trillion with a compound annual growth rate of 17%. Yeah, let's have a look at the shares beneficially owned. They divide this into three parts: Class A shares, B shares, and F shares. And then on the right we have the percentage of votes recorded, date outstanding. If we look at the left, we have the named executive officers and directors. The first one is Alex Karp, that's the CEO of Palantir currently, and he has 5.1% of the votes. The second one is Stephen Cohen with 3.1%. Then we have some other directors. They are listed with a star. And then there is Peter Thiel. He was co-founder, also from PayPal, but also from Palantir. He has 13.1%. And if you sum them up together, all executive officers and directors as a group, 11 people, they have 50.2% of the votes. Yeah, when I'm analyzing companies, I'm always looking at insider trading. Well, if you see here, it's all red, whether it's director and CEO, they are all selling. But talking about Alex Karp, on May 19, he sold his shares for approximately $39.6 million US. So no one is buying right now. There are two things that I want to talk about regarding stock-based compensation. The first one is the big concern hanging over the stock and its profitability metrics is a large amount of stock-based compensation being issued to employees of this company. For example, when removing the cash paid for taxes related to stock-based compensation, free cash flow was actually only $116.17 million during the first quarter, making the adjusted free cash flow margin only 33.9%. instead of 44%. Well, having said that, I do appreciate that the employees and management have strong alignment with shareholders and also recognize that this stock-based compensation does enable the company to attract and retain top talent, which is absolutely critical given their sector and also their business.
Luis asks, can you expand on Palantir's stock-based compensation? Will it further dilute the total shares of the company by increasing float each quarter? And how much longer will it significantly impact EPS?
Thanks, Luis. We have very low dilution when looking at our fully diluted share count. So far this year, our fully diluted share count has increased less than 0.2%, so really, really low. With respect to SBC, it'll normalize over the next couple of years as we're working through this outstanding overhang. And at the same time, when you couple that with the top line growth, we're going to continue to make progress towards GAAP profitability.
And I would just add that obviously everything Dave said is right here. The 20 basis points shows the discipline with which we are managing dilution. But just to zoom us out for a second here, why do we have stock-based comp in the first place? Equity is the fundamental investor-employee alignment mechanism. We want, and frankly, you should want, employees working their asses off with a long-term orientation to grow the value of the company. And so, yes, we plan to continue granting equity to our employees and providing them opportunities to share in meaningful upside in the company in order to maximize your shareholder value.
Great, Dave. I'll stick with you. Jason B. asks, why does Papa Karp keep selling his shares?
Jason, thanks for the question and nice Papa Karp reference. We'll call him Alex here. So first off, Alex is one of our largest stockholders, but he has two large option grants that are expiring at the end of December that can't be extended. And so when he goes and exercises these options, it's going to create a very, very large tax bill just to exercise and hold the shares. And as a result, you've seen tax-motivated sales as well as many corresponding exercises for shares that he'll continue to hold. And even after this, he'll continue to be one of our largest stockholders. If you're interested in the nitty-gritty, you can check out our filings if you want a more detailed look.
Cutting-edge product and increased efficiencies in distribution drove exceptionally strong Q1 results. We generated revenue growth of 49%, bringing Q1 revenue to $341 million. Adjusted operating income increased to $117 million, representing a margin of 34%. And adjusted free cash flow increased to $151 million, representing a margin of 44% and a $441 million improvement from Q1 2020. This was backed by strong first quarter billings of $362 million, up 248% year over year. Looking at our revenue performance, our total first quarter revenue growth was 49%, ahead of our prior guidance of 45%. The combination of 49% revenue growth and 44% adjusted free cash flow margin is indicative of the unique underlying unit economics of our business. Our U.S. business ended the first quarter with a nearly $800 million annualized revenue run rate, as total first quarter U.S. revenue increased 81%, representing 72% U.S. commercial growth and 83% U.S. government growth. Looking at revenue by segment, first quarter government revenue was $208 million, up 76%. U.S. government revenue increased 83% year over year in the first quarter, and international government revenue increased 57% year over year. We expect this momentum to continue, as we have a significant pipeline of government deals building in Q2 and beyond that we believe will fuel durable, elevated growth in our government segment. First quarter commercial segment revenue totaled $133 million, up 19% year over year, and we are seeing particular strength in the U.S., as U.S. commercial revenue increased 72% year over year. In addition to that revenue growth, we are also seeing substantial increases in leads and new opportunities, and we've more than doubled the number of active pilots in our commercial business since February. Abroad, and particularly in Europe, we are seeing more muted commercial growth in countries that are still facing significant health and economic challenges stemming from the pandemic. But as Sean mentioned, we are continuing to invest in these regions to assist in their recovery, and we expect our business will accelerate as these regions recover. In the first quarter, we closed 15 deals of $5 million or more in total contract value, including 6 deals worth $10 million or more. We ended the first quarter with total remaining deal value of $2.8 billion, up 40% year over year. Remaining performance obligation was $626 million at the end of the first quarter, up 129% year over year. Average contract duration was 3.7 years, up from 3.6 years at the end of 2020. These results are particularly strong when considering government customers entered into shorter than usual contracts in 2020 to accelerate procurement as they responded to the COVID crisis. Moving through 2021, we expect these deals to renew and expand, which we believe will create tailwinds for both duration and deal value. First quarter trailing 12-month revenue per customer increased 29% year over year to $8.1 million. First quarter trailing 12-month revenue per top 20 customers increased 34% year over year to $36.1 million and represented 60% of trailing 12-month revenue, compared with 65% in the year-ago period. As we move through 2021 and beyond and increase distribution across multiple channels, especially into new market segments such as middle market and SMBs, we expect average revenue per customer growth to taper, reflecting our broadening customer base. Next, I'll discuss our margins and expenses on an adjusted basis, which excludes stock-based compensation. First quarter adjusted gross margin was 83%, up 800 basis points versus the year-ago period. Contribution margin was 60%, up 1,900 basis points versus the year-ago period. First quarter income from operations, excluding stock-based compensation and related employer payroll taxes, was $117 million, representing an adjusted operating margin of 34%, significantly ahead of our prior guidance of 23%. In the first quarter, we generated $151 million in adjusted free cash flow, representing an adjusted free cash flow margin of 44%. As we continue to invest in our sales team, we expect related expenses to increase over the course of the year as these new heads come on board. With over $2.3 billion in cash on the balance sheet and strong free cash flow in Q1, we paid down our outstanding debt in early April and expanded the availability under our revolver by $200 million for a total capacity of $400 million, all of which remains undrawn. This provides us with substantial flexibility to pursue investment initiatives in support of our long-term growth targets. For our Q2 revenue guidance, we expect year-over-year revenue growth of 43% or $360 million, and we expect adjusted operating margin of 23% for the quarter. Additionally, for the full year 2021, we are raising our adjusted free cash flow guidance from break-even to in excess of $150 million on the strength of our first quarter. Continuing to execute the guidance strategy set forth by our CEO Alex Karp in our year-end 2020 earnings call with regard to long-term revenue guidance, we are providing and will continue to provide revenue guidance of greater than 30% for this year and the next 4 years at each earnings call.
And lastly, the opportunity and the risks. Well, I wrote several things down for you. The first one, for the opportunity, is the overgrowth of the business continues to accelerate. And I make a distinction between the government And the commercial side, well, the government-backed mode is definitely growing stronger. That's very good. And the real opportunity for me is in the commercial side. I split that up again. A, you have more Fortune 500 companies, and B, there's this expansion downstream to small and medium-sized enterprises. When scaled, the profit potential is definitely there. And what I like is the long-term focus from the management, and also that the revenue growth is 30% for this year and the next 4 years. At least that is something that CEO Alex told us. Furthermore, the software platforms, especially Gotham, they enjoy strong barriers to entry, including high switching costs and increasing network effects. And lastly, Palantir has the potential to become one of these key central operating systems of many US governments and other organizations. And then lastly, the risks. Well, for the short term, the stock has a relatively lofty valuation. Over the longer term, I think that the government growth might be limited, but the focus will still be on the commercial side, and that the growth of the commercial side will still compensate for the lack of government growth in the future. And lastly, the large amount of stock-based compensation. I read several articles about that. They had a discussion, but I also covered it for the conference call, so you can always listen back. The positive thing is that you want to have shareholder alignment with the employees, but you don't want to issue too much stock because that might result in shareholder dilution. Thank you everyone for watching this video. I really hope you enjoyed it and that you actually learned something, and see you on the next company.